Now, the government is pushing for a lot more access to cheaper credit as one way of jump-starting the economy. The Kenyan Bankers Association said the meeting with the regulator will take place this week. Earlier on, my colleague Uche Okoronko asked the economist Churchill Ogutu how realistic this pressure on commercial banks really is.
Yes, that speaks basically to the net interest income, and that the idea underlying that is basically how the banks are able to capture the market. Remember, lending works in two ways. They are attracting deposits from customers, so there's a deposit rate it's a cost on them, and also they are lending at the side. So you're looking at the spread between how they are able to mobilize the deposits and how they are able to lend. So basically the spread. As it is right now, the data as of July, we are looking at around 560 basis points. So there's a spread of 5.6 percentage point between the average lending vis-a-vis where they are paying the deposits on. But you see that even right now, there's been a push by the central bank. I think it's the last 3 or 4 months in successive, whereby the central bank is publishing across all the 39 banks that are listed, and rather the 39 banks in operational, where they are lending at, and also looking at the various tenors. So at least that is trying to bring out the transparency between central bank to see which banks are still charging expensive lending rates. On the other hand, this is an opportunity not just to look at the net interest income, the income coming from the net interest, but also to look at what we call the non-funded income. We're talking about some of the banks have started pivoting into asset management, others into bank assurance, and also into the trading activities. So the non-funded income will be key in the event that now the spread between what they are lending their customers and also the cost of the mobilizing the deposits is, at least to be able to diversify. So the banks that are able to at least increase their share of the non-funded income will at least build the resilience in a lower yield environment that you are foreseeing.
Now, what is also clear is that with this move, what the central bank is trying to do is sort of create some sort of balance. So is there a scenario where commercial banks can make their money and the central bank also achieves that intention of favorable interest rates for the public? And this, of course, with the central bank rate at around 12%, as you mentioned, when we talk about the 91-day Treasury bill.
And one of the metrics that we keep monitoring is now the private sector credit growth. And on a 12-month rolling basis as of September. So you're looking at the 12th where it was at September this year, the vis September last year. It just grew by 0.4%, and that's the lowest you've seen. So you can see that the credit mediation to the private sector has been quite low, and it has been collapsing. We don't know what the numbers for the subsequent months after September will look like, but it looks like it will be quite ugly looking at the trend that we've seen so far. So it is an opportune time as banks reduce their lending rates. At least they can also be able to revive this private sector credit growth, and also in a way to address the non-performing loans. The numbers that you saw at this October 2024 Monetary Policy Committee showed that the non-performing loans were quite elevated, above 16%. So if you reduce the lending rates by banks, at least you can be able to address even at least show up the mediation to the private sector, and also on the other hand, at least be able to alleviate the non-performing loans and also the businesses that have choked because of the high lending rates. At least they can now be able to slowly grow back into profitability amidst what we are seeing, the scenario we are seeing, that the central bank rate, as it is right now, 12%. We still expect it to go lower in the December meeting, looking at even where inflation currently is, and also our outlook on inflation, and also in some of the T-bills, we started trending lower. So I think as they are able now to revive the lending and also to address some of the sticky issues around non-performing loans, at least they'll be able to sort of build the resilience that is needed.